Hello everybody, McGee Wolf with the Wolf Group. A situation we're all dealing with in real estate these days is pretty significant. We have a very low inventory environment, as we all know, and one of the byproducts of that is it is a seller's market for sure. And in order to win the contract on a home, many buyers are having to offer a sales price that is above the asking price. And that's a problem for many people, and people can be very frustrated about it, of course. It's very stressful. It's stressful for the realtors as well. But in reality, what's happening is sellers are putting their homes on the market, and then that day, or within 24 hours, they have 4 or 5 offers. Some of them are for cash. They're all over the board. So to put yourself in the best position possible, many buyers are offering more than what the asking price is. But a wrinkle in there for most buyers is they have a limited amount of money that they can do that with. They don't have massive resources and reserves of funds. Maybe they're selling their home and they have X amount of dollars that they can bring into the transaction. So I have some techniques that we have implemented that have been helping many buyers win the contract and not have to bring additional money or substantially different amount of money to the table. It's a nice strategy that I think you'll benefit from. So this is how it works. So let's hypothetically say, we're going to use round numbers, that you're wanting to put an offer in for a home that has an asking price of $300,000 and you have 20% down payment of $60,000, and that's all that you can bring into the transaction. So how can you offer more than asking price, let's say by $10,000, and still stay within your budget? Because the 20% down is $60,000 plus another 10 is $70,000, and if you don't have the ability to do that, then that's a problem. So here is a technique that we have successfully implemented. The first thing you would do is only put 15% down. Well, I know that introduces PMI, and a lot of people think that PMI is a bad thing, but in many cases, PMI can be your friend. And for those that don't know, PMI is called private mortgage insurance. And that's a whole nother video I could do later about the history of that. But nevertheless, it gives people access to homes without having 20% down. But if you put 15% down, which is $45,000, compared to the $60,000, you have $15,000 that you can work with. Out of that 15, you can increase your offer by the $10,000 that you want to make, leaving you $5,000 left over. So how does the PMI impact your loan? Well, a couple of ways. The first way, which I believe is the best way, is to get a single premium PMI policy where you pay it one time. It's not part of your monthly note. So your note would not be going up as a result of the PMI. And if you have good credit, in the case of a client that we just did, the one-time single premium amount was like $1,020 on a $300,000 home. So if you think about it, that extra $5,000 that they had left after they offered an additional $10,000 to the seller to try to entice them to agree to the contract for that offer, they had $5,000 left. Well, they used $1,000 of that for the single premium mortgage insurance, and they were left with $4,000 in their pocket. Here is the little wrinkle that not a lot of people realize. Mortgage insurance protects who? It protects the investor against your default on the loan. So interest rates are tied to risk. The higher the risk, the higher the interest rate. Well, if there's PMI on the loan, it reduces the risk. And in this case, they were able to actually get an interest rate that was 0.125% lower than if they put 20% down. So a lot of people don't realize that. So their monthly payment was lower as a result of having the PMI. So it's a win all the way around. And it's a creative strategy that has been very successful for several of our clients, and if you would like to get more insight into how to do that, we can certainly help you with that. Now here's one other little option as well that we're offering for our strong borrowers who have very solid files and that they're fully pre-approved in every way. We will be able to close in 14 days from the signing of the contract. I know that sounds crazy in this environment, but we're doing it. And the key element to all of it is that the day that the contract is signed, we are disclosing and putting the file into underwriting, ordering the appraisal, and simultaneously the property inspection is being done. And by the time that's over, the appraisal is in, the file is in underwriting, and we're closing in 14 days. So sellers like that a lot as compared to 30 and 45-day closings. In this case, there's so much activity, it's not uncommon to have a 45-day closing. Sellers are able to get their hands on the money sooner and move on and purchase their homes from there. So those are a couple of ideas that you might find beneficial. Talk to your lender about it. We're certainly very interested to talk to you about it. Let us know how we can help you. And always remember, have a great day.